Thank you. Thank you so much. Okay. Let's start our last session. Very pleased to have this last panel where we just had a great high-level introduction to the issue of contingent claims in the government and the interconnections. And this panel is really going to get down to the nitty-gritty. And I'm not going to spend a lot of time introducing people. You have their bios, but I'm going to say we're just going to hear a lot of really well-informed, interesting perspective from the U.S. Congressional Budget Office. Today we have Carolina Rivera Rodriguez from the IMF and our own Bob Pindyck, who so they're going to be both talking about kind of how governments are thinking about these things and the size of the obligations, and Bob is going to take it to the climate front to finish things out. So Sebastien, without further ado, let you get started.
Thank you. So I got my slides, and I guess I'm going to move around. I don't know if that's possible, but I'm going to talk about the contingent financial liabilities of the federal government, and this is from the perspective of CBO. So I want to be clear, there's like 10 slides. I'm not going to go through them in detail. It's like if we were in class, I would give you a lot of reading assignments. There's a link on the report on which I'm going to draw a lot of the slides from. And then if you have any questions, obviously, we can talk more about it. So a quick overview of a presentation. So I'm going to talk mainly about the financial commitments of the federal government, and then I'm going to also look at supplemental appropriations for disasters, because there's also the other side, which is like non-completely financial. In terms of, I don't know if it's the luck of the draw, but we happen to have published something related to financial commitments of the federal government for credit and insurance programs very recently. So I'm going to pull a lot from that report. And then I'm going to define quickly those three measures that try to tackle these types of financial commitments from three different angles. And then after that, I will look at different examples. Bob already talked a little bit about PBGC, so I'm not going to spend much time on it. I'll talk about the relevant topic of the FDIC, and then, of course, the natural disasters. And like anyone at CBO, I like to also talk a little bit about debt, so I'm also going to include a little bit how those different financial commitments would relate to debt and different measures of debt. So to start with contingent claims related to those federal credit and insurance programs, what I'm trying to do here is just really talking about the financial commitments. So think about everything related to federal credit programs or insurance programs. And those represent what's going to happen in case there's a potential event that happens that results in a net outflow from the federal government. Most of those, are well known. It's in the housing and real estate programs. So Fannie, Freddie, FHA, student loans, that's been in the news very recently. The same thing for deposit insurance and the Orderly Liquidation Authority. And then finally, again, the insurance for private pensions. So the commitments are twofold. Some of them are completely explicit. So the federal government writes a contract and then just pays out if something happens. So this is something that happens for the deposit insurance up to the statutory limit of Fannie and Freddie pre-conservatorship. And then, post-conservatorship. And then you get the implicit one, and now it's Fannie and Freddie, more like pre-conservatorship. And then the idea behind it is you have that perceived notion that things will be guaranteed. And of course, recently you have deposit insurance losses above the statutory limit. You can think about it that way. So something that we do a lot at CBO is trying to measure the cost of federal financial programs that involve risk. And the way we do it, so by law, we constrain by what the budget committees and the legislation is telling us to do. So what we do is we either budget on the cash basis, so that happens especially for insurance programs, or we use what we call FICRA, that's legislation from 1990, where there we just do the cost of loans from their average default rates and all the associated losses, and we use a present value measure. Of course, there's an alternative approach for people here that are interested in market prices. You know that those approaches think that the government is risk neutral and we only target something like the average loss. But of course, if we want to introduce more that notion of market risk, a more comprehensive type of cost measure is the fair value measure. And then in that case, it reflects the market risk in the market. So in terms of the three measures that I mentioned a little bit before, the main one that is very interesting using financial statement from the federal government is what we call the covered amount. And that's just like if something happened, it would be the direct hit to the entire system. So think of it as just like the face value of the direct loans, the loan guarantees, or the insurance in force. The allowance for losses, so this is calculated by the different agencies. And that one is the amount that they recognize as the losses from defaults for insurance claim or for credit programs, net of all like future cash flows. And so this is in case anything happens. The net covered amount gives it a little spin because this one actually introduces the fact that there's those like statutory limits where the federal government wouldn't be responsible for. So you notice in the end for the whole of credit programs, you get a covered amount of $11.7 trillion. And then for insurance program, it's something like $25.6 trillion. So you may say, okay, well, how can I put that into perspective? If you sum both of them, right, you get something like $37 trillion. If you compare that to like the debt held by the public, which was something like, I think, $23 trillion in 2021, around like the same time, well, you notice that those contingent claims of federal government is 1.5 times the debt held by the public. So this puts that number into perspective. And you can even think about that total financial wealth of households in the United States. So same thing around 2021 is something like $115 trillion. So those like contingent claims would actually represent, financial contingent claims, right, would represent a third of that total amount of financial wealth. So pretty big numbers when you think about it. So Bob talked a little bit about the PBGC, so I'm not going to go back on that, but it insures all those pensions. And if you notice, so something interesting is at the end, when you think about the allowance for losses in 2021, you see it's almost like nothing. It's around like $3 billion. You cannot even see anything. And because what happened is that under ARPA, the American Rescue Plan Act of 2021, there was a financial bailout in some ways where they could draw on the treasury and get special assistance. So you don't see any like now problem there. So that really decreased that allowance for losses. So turning into the FDIC, this is a very interesting problem, right? So you notice what happened there is the fact that we have a lot of total assets and a massive increase in the uninsured deposits. And that happened again because of a federal government program in the 2020 and 2021, where during COVID, a lot of direct payments were made to either households, also businesses. And so you got a massive increase of those uninsured deposits will actually increase the potential risk, right? So you see that increase of 18% between 2012 and 2021. So now more on something a tad different, where actually it's related more for climate and natural disasters. So this is the FEMA Supplemental Appropriations for Disasters. So the Disaster Relief Fund that is organized by FEMA. And you notice something that is very interesting is that most of the appropriations for those disasters is done after the fact. Those are supplemental. So if you make the sum from 2012 to 2022, you get something like $525 billion total. And 70% of that amount, so the green pieces, is actually supplemental. So this is something that is done every year. There are normal appropriations where FEMA appropriates some amount of money, but only 30% of that is actually used on an annual basis, and then they have to complete it with those supplemental appropriations. One thing that you notice too is actually there's a small handful of events that are responsible for most of the spending. And those are hurricanes, is the very first category. And then the second one is COVID-19, that happened late in this period. And lastly, so last topic is about how do those different measures influence the debt. And so I'm going to talk about, so it depends on the debt and also on the type of laws that you're going to have. So we can do 3 more or less thought experiments. 2 of them are fairly simple and intuitive. The third one with the FDIC is a little bit harder. So for example, if you think about doing some debt forgiveness, right? Well, now you lost the value of a financial asset, right, from the perspective of the government. So the debt net of financial assets then will increase because that financial asset has been written down. But then the debt held by the public and the gross debt would not change because you already, the Treasury already issued debt in order to help pay for the student loans. So there's no change in there. For higher claims on mortgage guarantees, well, this is the example where all of a sudden the government needs to pay those claims. And so that was not anticipated. So here the 3 types of debt would increase because this time the federal government would have to pay for it. For the last one, the deposit insurance, this is a little bit more tricky because every time from the deposit insurance program, every time the banks pay a premium, that premium is then put into an account at treasuries called government account securities, and those are invested. And so every time there's a default, what happens is that then the FDIC claims back that money. And so now what happens is that you get an increase, obviously, of the debt net of financial assets because now debt must be issued to cover those costs. The debt held by the public is the same thing because now you need to borrow, right? Treasury needs to borrow in order to do that, so you get an increase. But the gross debt that contains the intra-governmental debt between the Treasury and the FDIC wouldn't necessarily change because this is covered mainly by the deposit injury fund. So you see there's a lot of interesting questions around those that are related to budgetary issues, but I think I'm running out of time, so.
Good, okay. So
I'm good.
Thank you, that was nice. Please, Carolina.
Carolina.
Thank you. Okay, so I think you hear me. Thank you very much, Debbie. And I was thinking this morning that I have heard so many different topics and I had a new one that I'm going to talk about. So I come from the Fiscal Affairs Department of the IMF, of the International Monetary Fund, and our function is to provide capacity development and technical assistance to governments, to ministries of finance to strengthen their institutional setting. And as part of that, we work in a number of topics. And what I want to discuss here is, that as I was invited to, is about contingent liabilities. And all that you have heard today is about contingent liabilities. And we have focused a lot in the US, but this is a factor that happens all over the world. So imagine here you have very strong financial system, very strong regulations, very strong supervisory, very strong ministries of treasury. Go to countries with low capacity and low income. And you face the same challenges. And I loved when Bob mentioned that we all know that there are some basic functions and that the government has to provide those functions, but many times the capacity is not there to provide the functions. So that's where we play a role, and a role that we have been trying to do across the globe is to strengthen the management of fiscal risks and provide governments with some frameworks to manage contingent liabilities. But this sounds much easier than done. So basically, why do we care so much about it? Public debt has risen significantly. Public debt is something that goes against the long-term sustainability of governments, and many times this debt sustainability and the increase in debt is due to the realization of contingent liabilities. And two shocks that were very important, the global financial crisis and the COVID. And when those two shocks happened, what we see is that there's a massive materialization of contingent liabilities, and that many of the governments are they find surprise. They didn't know that was there. They didn't know it was coming. They only see that it has happened. Basically, we estimate that around 37% of GDP, the increase in debt due to the global financial crisis, and around 20% due to COVID. So when the global financial crisis happened and the fund found itself that the reports that the government were giving the fund in terms of Article 4 and the programs were reflecting realities that were not there, it was clear that there was a problem on fiscal transparency and on reporting. So the fund produced the Fiscal Transparency Code, which is to set the standards in terms of the transparency of the fiscal numbers and to be able to track better what governments have. The Fiscal Transparency Code resulted for us in fiscal transparency evaluations, where we go to the governments to assess the Pillar 1, which is about the reporting, all the reporting and the calculation of a public sector balance sheet for the governments, for the countries, I mean. The second is about budgeting, and the third pillar was about fiscal risk management. And it was clear from the fiscal risk management pillar that this was a function that even advanced economies such as the UK had very little in place. So since then, we are talking at the beginning of 2014-15, work on fiscal risk management started in my department. And the first thing was to design the framework to be able to talk to governments about fiscal risks. And the framework, which is what I'm showing here, is how we think about fiscal risks. So the first part is to identify and analyze fiscal risks. And for these, countries need to start to understand what kind of fiscal risks are there, identify how they are, and quantify them. And for that, they need tools. And many countries don't have tools, so we are working in tools not as advanced as the ones I have heard this morning, but we need to start from a completely unknown to starting to get to know better what the fiscal numbers are. Once they have the identification and analysis, comes what we call the mitigation phase, designing policies to mitigate the risks. So if you are issuing guarantees, how can you, since the design, mitigate the probability of the guarantee becoming called? And if it's called, how can you try to get a sense of how much it's going to be and how much you can afford? Then either you mitigate the risk or you accommodate, and by accommodation we mean, as was discussed, supplementary budgets. How is your fiscal stance? How's your fiscal space? How much you have in an initial appropriation? If you need to do supplementary budgets, how much you can have there. And finally, disclosure. Disclosure of fiscal risk is very important. Hiding information is not good for anybody. Hiding information creates more problems. You can never hide that information. So disclosing, it's even important in terms of markets. We have evidence that countries, and I'm talking here about emerging economies that are more transparent, markets read them better. Because there's always this worry that if I put a lot of information about contingent liabilities and financial risk, I'm going to be punished by the market. But the markets, as has been discussed this morning, they know more than what the government does. So just showing that you are transparent and disclosing them helps. So we have designed different tools for managing fiscal risks. And what I like about this slide, first, that it reflects a lot of work from many people in my teams, but more importantly is that they are applicable at all capacity levels. And that's the message I want to send here. I know we are very much in a US, very focused discussion right now, but we are really, really trying to do this across regions and across income levels and capacity levels. So the toolkit was, so I said we had the fiscal transparency evaluations. We discovered that fiscal risk was kind of weak. We started to work on that. COVID hit, and countries immediately were asking for support on understanding of the policy measures they were taking, what kind of risks they were creating. And it was encouraging for us to see that countries were thinking about that. So I don't know, some of you may have heard, part of our slogan back then is do whatever it takes, but keep the receipts. Like, and for the fund to say do whatever it takes, that's a new fund. Many times people don't recognize that, but it is. But keep the receipts was, you need to know what you are doing. And you had central bank doing policies, and I'm gonna touch on that a little at the end, and you have the governments producing different types of responses to the COVID. So in terms of the risks, the fiscal risks, and I'm gonna move here because I hope this, because I cannot see. So the FRAT, the Fiscal Risk Assessment Tool, trying to help governments have a big picture of all the potential fiscal risks that they have. And the more they work, the more information comes, the better quantification they have. The public sector balance sheet, assets and liabilities, and trying to see the mismatches between assets and liabilities and what do you have there. And also for countries that are rich in terms of assets, how can they do a better management of assets so that they can have better return? We work a lot with public corporations, and public corporations are like, you don't know what's in there in many countries. We designed two tools, the health check tool, which is simulation of just financial indicators, but to understand the health of the largest financial corporations in countries, and the stress testing the financial corporations. All of these may seem very basic, but imagine you go to Liberia, or imagine you go to the Gambia, and we can talk about this. We work with whatever information they have, which is very little, but little information is better than no information. And the only way I see for you to start the strengthening is working with what you have and knowing where you want to go. We had two tools for guarantees, one for discrete guarantees, another for standardized guarantees, and this was just in response to COVID, because governments were giving guarantees to small and medium enterprises. In many countries, that was a response, while others were giving guarantees to the airline company. So how to manage these risks, but all of this was done as the guarantees were issued. Like, we didn't have 3 years to understand and come for the best model to do this. It's with the knowledge we had and the information the governments had, together we tried to create this. Fiscal stress test. I mean, we have been doing this for a while, but then helping governments do the stress test. And we did then one for COVID to try to understand what could be the impact of COVID, simulated the impact it had on growth, it had on different functions. And finally, we have the Fiscal Risk Assessment model, the PFRAM, which is for PPPs. We know governments do PPPs, they get the financial contracts. The contracts are full of potential problems. The private sector has very strong lawyers. The public sector has very poorly paid lawyers, and they are both negotiating the same contract. So it's no surprise that a few years later, you see that the governments are in trouble. So this is just some of the approaches we have for governments to work on fiscal risk. So COVID hit. We were working on this, and then we saw central banks coming with a lot of responses to COVID. So we, in the fund, as we have the fiscal affairs department, you have the capital markets department. So they do central banks, they do all of the issuance of bonds, and we do the fiscal part. And it was very interesting because they were worried, or they were trying to understand the policies that central banks were doing, how were they making more vulnerable central banks, and how could the government support central banks so that they didn't have a problem. We saw that the central bank was taking many risks that would end up coming to the central government, and that will increase. Of all those potential risks that I showed you, we didn't have like about a central bank. So we did a joint paper. It took us a lot because it was two very different languages and different ways of seeing this. And the point of the paper was to understand better the quasi-fiscal operations of central banks. because basically some of the responses of central banks were quasi-fiscal operations. And the final purpose of the paper was to decide the ways in which these first they could be better understood, but also how to manage them. I have here just some of the typologies of the type of measures that were taken by central banks, and this was information from 60 central banks across the globe in very different quantifications, but we tried to come up with typology about how to think about the financial risks and the policy risks, because poor policies result in fiscal costs. So that's where or you need to understand what are the policy the decisions you're making and the costs. So basically we saw that the response of central banks to the COVID-19 was much larger than the response of central banks during the global financial crisis. So it became in this picture or this map of potential risk of governments, central bank became more of a potential risk than even in the global financial crisis. And that's something that has not been very discussed. We hope that is not gonna evolve wrong, but our role here was to try to identify and quantify. The document I'm talking about is a working paper. Working papers, IMF put them out there to create debate. So it's not a defined paper, it's just to have conversations. And the proposals in terms of how to manage this new set of potential fiscal risks is to have, to understand better the delegation of functions and responsibilities. And when Bob earlier in the last conversation, he was saying, or that's how I understood, that the function, there's a function and who does the function and how the institution responds is part of what innovation brings and institutional building is. I think this is similar to here, understanding where the central bank can play a role and why, or where the same function, exactly the same support can be better provided by the government with more transparency in the fiscal accounts. Intervention design. So even the same way as the public sector have sunset clauses or escape clauses, or the problem of many of the policies we do is that they are open-ended. You don't have a sunset clause. And then try to get that back. Trying to, if you're doing a transfer to a vulnerable group of people to respond to a crisis, if you don't talk about when that is gonna be over, it's very difficult politically to get it back. So here is the importance of those type of institutional design. Financial arrangements, how central banks and ministries of finance, treasury work together better. There are countries in which, we look for independence of the central bank. There are different ways in which governments and central bank interact, but defining this interaction would be important. And finally, the policy coordination. Many countries showed during the global financial crisis that it was possible to have coordination between the central bank and the ministries of finance to an extent that they had not done before. That happened in many places well, in others not so well. So basically, that was my presentation. As I said, what we do is support governments to build these institutions, work with whatever available information is there. And the good messages or the optimism is, as governments start working with these, they also understand the importance of having information. And that government having to produce the information because they need it is very different to government producing information because the IMF tells them to produce information. So I think this building and working with governments, it's a way in which we can move forward this agenda. And my last message, which I have said many times, even in very low capacity, little information, something is better than nothing, and you have to start somewhere. Thank you. I think you don't have slides.
I don't have, no, I don't have any slides. I could sit here or go up there.
Whatever you're comfortable with.
Oh, okay, I'll go up.
Thank you for grabbing my stuff. I was looking for. Sorry.
So no slides, sorry about that. I'm going to talk about real options and government's real options. So the simplest thing to think about is a bridge. We're going to build a bridge. There's one down there and there's one down there, but it'd be nice to have another one right here. Just go out the front door. But the problem, of course, is that we don't know what the value of that bridge is. We have a sense of what it is today, but we know that the value is fluctuating, and it's probably a geometric Brownian motion. Makes most sense, I think, for the bridge. And that means there's an option premium. And we have to think about what that premium is. It says that if we did a simple NPV, that would not give us the right answer because we'd be missing the option premium. Now, I want to focus on, we're using the word option, I want to focus on the irreversibility because that's what makes it an option problem. If we build a bridge and then we say, the demand for that is low and it didn't take off, we thought a lot of people would want to cross the river over here. They don't. What a mistake. We can't undo it. It's done. You can't use the bridge for anything else. It's money that's been spent and it's irreversible. And that's very important. Now, first, in terms of the government, the US government, I'll get to other governments in a moment. Debbie, you can correct me. I mean, the US government hasn't figured out yet what discount rate to use for simple NPV. And, figuring out how to do an option analysis of building a bridge, I can't even imagine that. And we're not going to build a bridge over here, but there is a tunnel that may get finally built through the Hudson River between New Jersey and New York. And I assume that that's so far in the money that they don't need to work out the value of the option premium. But maybe it isn't, I don't know. But they're not going to do it. It's just so far away. But let me turn now to environmental issues and climate, and this is why it's the irreversibility that matters. So in the case of climate, if we take action, now there are many kinds of action. An action can be tradable permits. It could be a tax, a carbon tax. This is a simple option, a simple thing, a policy, a carbon tax. It could be a subsidy for electric cars or whatever. These are all things you can do. These involve sunk costs, and so they are irreversible. And we know that there's a lot of uncertainty about what the value of reducing emissions is going to be. A lot of uncertainty over climate change. I didn't bring a copy of my book, but you can look at it to get a sense of the extent of the uncertainty. A lot of uncertainty about climate. And that says that, maybe before we impose these sunk costs, we want to wait because there's an option premium. You just do a simple NPV calculation, cost-benefit calculation, you'll get the wrong answer because it's an irreversible expenditure. But in the case of climate, the irreversibility goes the other way too. And the reason is that as you emit CO2, it accumulates in the atmosphere and stays there for a long, long time, over a century. And what causes the increase in temperature is the atmospheric concentration. It's not the emissions. It's the growth of the atmospheric concentration that causes warming and the impact of warming, okay? Well, that irreversibility has the opposite effect. That says that the NPV, doing a simple NPV calculation, is going to lead you to wait when you shouldn't. It'll lead you to underestimate the benefit of acting now. So you have these two opposing irreversibilities, and there have been a number of studies trying to figure out which one dominates, which irreversibility is more important. And the answer is, we don't know. So these studies have not been, we don't know, literally. I mean, the studies show that there's just too much uncertainty over the things that go into the calculations of the premia that affect these two opposing irreversibilities. Now, having said all that, I want to say just a little bit about discounting and how we think about climate change. And I'm going to put the basic option calculations aside. So when it comes to climate change, discount rates are very important, and they're important because things don't happen quickly. Climate change occurs very slowly. We expect that if there's any kind of catastrophic outcome, it's not going to happen for a while. A while could mean 20 years, 40 years, 60 years. It's out in the future. And the problem is that we don't really know how to discount things that are far out in the future. And the basic conflict is between whether we use market rates, opportunity cost of capital type of thing, or whether we use something ethical. So if you use a market discount rate and take one of these models, these integrated assessment models, which are these made up models, and do a calculation of what is the social cost of carbon, and you use a discount rate of 5%, you're going to get a very small number. And the result is going to be it's very, very hard to justify doing much. If you want to get a big number for the social cost of carbon, you need a very low discount rate, something like 1 or 2%, at most 2%. How do you get that? Well, the way you get that is you have to argue that the market rates are not relevant. What's relevant is a rate based on intergenerational ethics, because it's not us. We're not the ones that are going to suffer, at least those of us who are over, 50? I don't know. In this room, 40, 50, we're not going to suffer. It's going to be our grandchildren that are going to suffer. And it's not fair to them to discount their welfare. And that's an argument that was raised by Ramsey way back 100 years ago. Ramsey wrote that the only ethical discount rate is 0. By the way, he was not an ethicist. I mean, he did economics, but he claimed that, and people turned to that and said, well, Ramsey said that, and therefore we want to use a 0 discount rate or a very low discount rate. And that's really the argument that many people now use to argue for a very, very low discount rate, something like 1%, when calculating a social cost of carbon, and that will give you a high social cost of carbon. My problem with all of this is that these analyses that look out 100 years, 200 years, the studies now that go out and calculate social cost of carbon go out 200 or even more years to 2200. Well, think about this a little bit. What's going to happen in 200 years? What's going to happen in 100 years? What's going to happen in 50 years? We know nothing about what's going to happen. I mean, what's the nature of the uncertainty? How would you characterize probability distributions for 50 years from now? And then think about, some of the catastrophic events that might occur well before climate change in the next 50 years. Things like nuclear war, pandemics far, far worse than COVID. The Spanish flu of 1918, 1919 was far worse than COVID. And the CDC says that we can expect things far, far worse than that in the next 10 or 20 years. So you start looking at all these things that can happen, and you talk about these forecasts going out 100 years or longer. And to me, it's just so almost, dreaming. I mean, I just don't see the basis for it, what it tells us. Anyway, let me stop here because I'm just supposed to offer a few remarks, and I've overstayed my welcome.
Okay. Well, I guess I'll start off in the usual with a few questions and then open it up to other people. So I wanted to say at the beginning and didn't that, I really am impressed by organizations like CBO and the IMF that are really trying to very seriously look at contingencies and try to find a way not just to quantify them, but to make them real to people. And so I wanted to start by asking both of you a little bit about communication. I mean, you alluded to the communication challenges, but maybe if you could say a few words about what has been effective, like when you're talking to people, what resonates with people to make the contingent claims feel real, or anything you want to say about communication is fine. I don't want to make it a hard question, but just say a little bit more about, the communication challenges and what you're doing to address them.
Understood.
Yeah. I mean, that is a very good question. I think not only contingent liabilities, but fiscal policy, it's difficult to communicate. I mean, people think that I work in a very boring topic, and I think it's very nice, but nobody understands it. And I think it's because it's not part of, you need to make people feel about it, have a feeling. So I think, and that's part of the advantage when big crises happen, like everybody gets hit, unfortunately, but that's a moment of awareness, and that's a moment in which you can build about why it's important to do technical work, why it's important to create information, why things happen out of nowhere, and then you cannot explain. So one, I think using crisis as a communication tool is very important, and it also helps in terms of policy reform. I mean, when you bring to Congress, to Parliament, reforms that are difficult as part of a crisis package, I found, and I come from Colombia, and I went through a very difficult crisis at the beginning of my career in the Ministry of Finance, and it was much easier to sell to Parliament difficult reforms, pension reforms, labor reform, reform of the intergovernmental financial system, so that the subnationals, we had a very nice decentralization model that was going to get the central government broke. So you needed to change that formula, but the formula was in the Constitution. And for that, you need communication. So one, I do think that taking advantage of crisis, it's very important. Second, I think simplicity in language. I mean, if you want people to understand, you have to make it easy for people to understand. And many of the things that we do are very technical. Like when you talk about budget, I understand because I was budget director, but when I talk to somebody else, they don't understand half of the words we're saying. And actually this morning, many of the acronyms used, or the ones we used, for me, it's like I don't know them. Same thing happens in fiscal policy. People, we tend to think that everybody speaks our language, and our language is very technical and very concentrated in our work. And third, I think using technology, so we promote fiscal portals, open information, citizens budget, all those tools are to just make people aware of what is there, so that you can have at the end the policy discussions you need to have to make policy reforms. And finally, I think when government lies about the numbers, that's a problem. So one, building trust, part of communication goes with building trust and being transparent on the information, but I also think media helping also in revealing when there are issues with the information is useful. But for that, you also need to train the journalists, because they also don't understand the languages. So it's a big program.
So for CBO, at the macro level, so starting really higher up, so we try to tend to have products that are very clear, because our audience is members of Congress and the public, as well as staffers, and we need to explain very well even to the staffers, so that then they can report it to their Congress person. So that's something that is very important, and we take at heart. We try to have also products that make something like very technical, like working papers, but also reports that are very accessible, and also visuals. We invested a lot in infographics, so that we make people understand how things work. Like the budget before was something very mystic, and people didn't really understand all of the appropriations, how it was working. And we tried to do primers on those topics that are overly accessible, so that people can get there. On the topic of contingent claims, so obviously that report was timely at the time. It was published somewhere in March, so right before the crisis happened, and we got questions, some question on those topics. But every year, for example, we publish that fair value report of credit programs. So every year, new credit programs that are approved go through that cost when we say, what is the cost of those obligations moving forward? And for that, we use something that reflects market rates. And we explain through, again, a series of primers how that measure differs from like the measures that are in legislation. So how it differs from the normal present value that targets the average cost of those programs, how much we take into account the market risk. And that's been proven to be helpful, at least from the feedback that we got.
Yes, yes. Let me ask Bob a question, just put you on the spot. So, I mean, you were a bit nihilistic, so I'll ask you to be to take a side.
Okay.
So you said, well, you know, there's clearly we know almost nothing, so there's value in waiting, but then there's value in not having irreversible harm. So, and that we don't know. But if you had to make a betting man's guess, I mean, how, you know, you've been thinking about this data a lot, and so you can't quantify it.
So the other side of it is called insurance, and that is that, you know, what matters with climate is just one thing, and that's a catastrophic outcome. So if you look at sort of middle of the road projections from the IPCC, you know, they're not anything terrible. I mean, there'll be more hurricanes, more storms, and so on, things that you could adapt to, the world could adapt to reasonably well. The question is the chance of a catastrophic outcome. And we don't know what that probability is. Is it 5%, 10%? And how catastrophic would it be? But that's the problem. And so that means that you have to think about insurance. And insurance means investing now in adaptation, for various forms of adaptation, and reducing emissions to the extent possible. I'm very pessimistic about what's going to happen with reducing emissions. The United States and Europe are making progress. They'll make more progress. But the US and Europe together, combined, account for only 30% of global CO2 emissions. 70% is the rest of the world, and that 70% is rising. So China, India, Pakistan, Bangladesh, Thailand, all of Southeast Asia, Indonesia, Malaysia, their emissions are rising rapidly, and they very likely will continue to rise. Now that could change, but that's the real issue. So I'm pessimistic about that, and I think we need to do investments in adaptation to buy insurance, because otherwise we don't have the protection against the possibility of a really bad outcome.
Very good. Let me open it up to questions. Doug?
Maybe a few minutes.
It's a big room.
I have a question for Sebastien. I am continually looking for a list somewhere of all the different ways that the government steps in by statute to cap or provide insurance to private parties. Two examples would be that we have, you know, a cap on private responsibility for oil spills. We have a Price-Anderson Act where there are two tiers of private insurance, but actually the government is the insurer for the entire pool. And I would love for there to be a list somewhere of just all the different statutes that are doing these types of programs for people. And my question is, does it exist or could it exist?
It's a tough question. So that's something that is more for our budget analysis division. I do not think top of my head that it exists, but I'll ask and I'll get back to you on that.
I could partly answer that most of that is off budget. It's statutory, but it's not budgetary. So I'm guessing that the budget analysis division couldn't answer the question for you.
But if a list exists, that's a different.
Yeah, but I think
could find a
we
list.
won't know.
Be the one to try to tally that. Even if you don't know how much it's valued.
I think it's kind of invisible. This has to do with the fact that so many contingent liabilities, maybe arguably the biggest ones, like you know, the protection for the nuclear industry, right? There's capped liability, or there would have never been any nuclear power plants. But there's no, as far as I know, there's no budgeting for the absorption of that risk, and it would be very hard to put a price on it, but there's no statutory reason that anyone has to put a price on it because no money needs to be paid out at the moment. So I want to highlight what Sebastien went through kind of quickly, is there's so much of what the liabilities are implicit and not explicit. And he gave some examples, like when he talked about FEMA, the fact that we know that every year they're going to cover X trillion dollars, but they only budget a small fraction of that. I mean, that one is actually relatively transparent because it's predictable. But then there's all these other things that are off budget. I think you had, a continuing theme of today has been Silicon Valley Bank. And I think, an interesting question is, how would that have changed? We've been talking about what a big liability has been effectively taken on by the government writ large to insure uninsured deposits. And so, Sebastien, I guess a question for you is like, how much of that is showing up on the budget, will show up on the budget? I have a guess, but I want to hear you say it.
So I cannot tell you how much will show up on the budget. What I can say is, so first of all, this has data up to 2018 or to 2021. So we didn't have any of those numbers before. But if you look at what we published, the allowance for losses, so what we're thinking about was $0.2 billion. So of course, that's, ex ante. Ex post, we know from numbers that have been released that the failures of those three banks was around $30 billion. So you notice that those don't match. So that's why it's so important for us to have released this paper so that people can look at the covered amount, which is the bigger amount, not just like that present value, including all that probability of default, because those numbers would give you a truncated idea of what could actually happen ex post. So that's why, like, on the budget, that's the question mark, because now you're going to get assessments, right? They're going to come back. So it's kind of difficult to predict exactly how much it's going to be.
I was going to ask a question. We talk a lot about metrics and measuring these things. Somebody in the first session had the insight that it's the consequences to this information that's more important. The information's out there if you dig for it, but what are the consequences? And to channel Bob Merton, if you think of nirvana, how would you design it in terms of consequences? And just very quickly, at FHA, there were two things in terms of calculations about the FHA insurance. One was sort of the Anti-Deficiency Act, that if you somehow spent money that wasn't appropriated, you would go to jail. And then the other one was there was a 2% capital requirement of sorts, that if you violated it, you had some future commissioner would have to have a hearing in front of the House and endure 2 hours of being told you just violated the law. Obviously, it was the Anti-Deficiency Act that really got my attention in terms of the numbers. And I didn't really care much about the 2%. I was polite, but I didn't care. How would you design something to use just even basic information, whether it's around climate or banking or any of these things, where it has actual teeth that you're following the number rather than just disclosure? Pick any program.
Everyone's looking at me, but from the perspective of CBO, so we don't make policy recommendations. So this one will be simple. That's why we provided multiple analysis in that report of exposures, so that we let people decide which measure they find more appropriate. So
I think from the work we are doing, so I talked about the Fiscal Transparency Code and the evaluations, and what we are trying to do there, and goes a little also to this difference between explicit and implicit contingent liabilities, is to expand the coverage of the reporting to be able to have not only the central government but all the public corporations and have that information available, because what happens to many treasuries and ministries of finance is that they even don't know how many contingent liabilities are there, because they don't know how many guarantees have been provided individually at the subnational level or at the corporate level or at the sectoral level. So part of what we propose is to be for the Ministries of Finance and Treasury to have a survey or to have an inventory of what is out there. I think very few countries, if any, have them. But going into that, just listing is important, and then you start to quantify. And then it's clear, perhaps you cannot put everything public out there, but if you are trying to get this aggregate measure, that gives you a sense of how vulnerable you are. It's difficult, and basically we have seen, and there are very, very bad examples of guarantees given for purchases of boats that were half of the amount of debt. They materialized, and the Ministry of Finance claimed that they had never seen even the contract. So looking at these, preventing this, or creating the function of having to do this and being accountable to Parliament, accountable to having to go and explain. So we also say having fiscal risk statements and produce them annually and making them part of the budgetary process. It's also a good measure, but I mean, it's work in progress. Okay. Yes.
So I actually have a question that could be for Sebastien or Carolina or both, and one for Bob as well. In November 2020, the Federal Reserve switched from buying securities sort of on an ad hoc basis to another massive flow-based asset purchase program at a time when the economy was already turning the corner, and they made very strong commitments. Much stronger than in the global financial crisis, for how long they were going to maintain that program. Those programs are designed to take on risk. That's what they do. That's how they lower longer-term interest rates. So let's just stipulate, particularly for Debbie, that they bought the securities at fair market values. But how should CBO be thinking about? But they're losing money massively now. Of course, $10 billion a month, I think. And they have huge embedded mark-to-market losses. So how does CBO think about that? How is it scoring it? How should it have been thinking about it in real time? Should the central bank, I know that the view from within the central bank was there's effectively no cost. This is costless. We can expand our balance sheet as much as we want. So I think that fiscal and budgeting could be a good discipline on central banks for making decisions, making sure that they weren't just doing what they would take, but they were also keeping their receipts. And then, so my question for Bob, I thought those were really interesting remarks, which of course means that they align with my views to a large extent. So how do you think about the geoengineering as a possibility? And how do you think about technological change as another thing that's going to be happening? Probably only in a good direction, I would think. But so,
what order do you want?
Well, go backwards.
All right, so I'll quickly answer yours. So geoengineering, if those of you who don't know, solar geoengineering, the idea is that you take sulfur, you bring it up to about 80,000 or 100,000 feet into the atmosphere, upper atmosphere, and you burn it and release sulfur dioxide. The sulfur dioxide combines with water vapor and creates a aerosol of sulfuric acid. And what that aerosol does is it reflects sunlight. So you don't get rid of CO2, but what you do is you eliminate much of the greenhouse effect of CO2. Now, the problem, of course, is the CO2 is still there, which means there's some issue about ocean acidification. The CO2 is still there, and the sulfuric acid eventually comes down after about a year. So you have to keep doing this, all right? It's something that we probably don't want to rely on for the long term, but as an insurance policy, if, wow, things are really bad and we got to do something, it's something we want to have. And the problem is we need to build the airplanes that will fly to that altitude. Most airplanes won't do that. will fly to that altitude to release the sulfur dioxide. So I think we should definitely be spending money. And by the way, once you have the airplanes, this is really cheap. I mean, one country, a smaller country, can do this. It's really cheap. Sulfur's cheap, and it works. So it's something we should be doing as simply insurance. And then for technological change, we need to be investing more money in forms of adaptation that are technological. It could be carbon sequestration, seawalls, things like that. And then you have the harder questions.
So it's like,
This.
in terms of a Federal Reserve, so CBO really doesn't do much on the Federal Reserve side. The only thing it comes into account when we do the remittances, so more on it comes into the taxation and the revenue baseline. So we would look at how much impact it would have later on remittances, and that's limited at that. Of course, we consider it in our economic outlook also, but the nitty-gritty details of it, I don't think we have time to go into this, and that's more like the macro division in that respect.
How are you scoring the losses now?
No, but let me just step in because I definitely know the answer, which is yeah, because I was at CBO for a long time. So the debt is considered a means of financing. It doesn't get scored. It is an assumption that it's issued at fair value. And then what happens ex post just is what happens ex post. I mean, all budgeting is ex ante in the sense that you're making a forecast of what something is going to cost. And, when you issue the debt, you issue $100 of debt and you get $100. So that's a wash. And then it's not part of this. It's not an expenditure. It's a means of funding the expenditures, and it's the expenditures that get scored. So CBO will never solve our debate.
But part of our work on the public sector balance sheet, we did the Fiscal Monitor is this publication that we do twice per year. 2018 we did public sector balance sheet, and in that we build a data set of public sector balance sheets around the world, and there you have central bank is one of the entities that goes into the balance sheet. And when you put the central government, the subnationals, the social security, and the public corporations, and the central bank, you start to see there the relationship between assets and liabilities, and when the central bank buys the government, and then, so you start to get this more comprehensive picture and trying to then simulate what happens if something happens in the interest rate.
But I think his question had to do with what I don't think these balance sheets you build, correct me if I'm wrong, but I don't think they mark to market necessarily. No. And his was a question of marking to market, essentially. And none of these agencies, as far as I know, every once in a while a study comes out which marks the US debt to market, but it's not a routine thing.
I was also asking this type of story. We're actually making real losses right now.
Mm-hmm.
So it's not necessarily the losing a lot.
It's not real losses. So we'll talk about it offline. Yeah. It's not a loss. It's just the net cash flows are less than they would. There's more cash outflows than there would have been, but they wouldn't call it a loss. They would just, on a cash accounting basis, you see the outflows.
Well, Perry gets the last question.
I just wanted to.
It's on, I think.
Okay. I just wanted to ask a question about the sort of irreversibility on both sides. I guess I'm going to just push back on that. It's not really a comment rather than a question. So apologies. But it feels to me that if we choose to mitigate today,
This one's on.
Okay, sorry. It seems to me that if we were to choose to mitigate today and the climate was fine, we could always tap into fossil fuel reserves later. But if we didn't mitigate today and the most catastrophic scenarios of climate change materialize, that feels truly irreversible. So I guess I kind of wanted to understand exactly what you mean by being irreversible on both sides.
Yeah, so mitigation, reducing emissions is costly. And it isn't, like we're going to just keep all the oil and have a reserve of oil that we can use later. It's expensive. And if you want to reduce emissions, there are many ways to do it. But, people have to insulate their homes, use electric, solar panel, whatever it is. That's an irreversible investment. That's what I meant. The damage, if a catastrophic outcome occurs, that's the damage. That's the issue of how bad would it be if something happens, if it goes the wrong way. The irreversibilities are that if you spend money today, you can't get it back. If you build a solar panel today or wind turbine offshore, that's all it's good for is a wind turbine. So, you can't use it for anything else. That's irreversible. And then on the other hand, if the CO2 accumulates in the atmosphere, that's irreversible. It stays there for 100 years or more. Those are the irreversibilities. The uncertainty is over the benefits of doing these things, the benefits of reducing emissions, which is avoiding damages. And since we don't know what those damages will be, the benefits of avoiding them are uncertain. And we're learning more as time goes on, but right now they're uncertain. So it's a typical, and it really is a kind of a standard option pricing problem with a very, very complicated set of distributions for the uncertainties.
Great. Well, we're out of time, and I want to just very briefly thank everyone for being here today, and thank all the panelists and everyone who spoke before. We'll see you next year, hopefully. I've learned a lot personally. I also want to thank again Ed Golding, Deirdre Wade, Alex Gant, who made this all possible. So thank you all very much.